Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship, the parent owning the subsidiary, having a controlling interest over 51%, but not 100%. Therefore, we still have this non-controlling interest. There's also going to be a loss on an intercompany transfer of equipment. In other words, equipment being transferred from one company to another. Oftentimes we've been recording these problems resulting in a gain. This time that transaction is going to result in this intercompany loss that we'll have to deal with within the consolidation. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have the information on the left-hand side. We're going to enter the detail for this information in the blue area on the right-hand side, and then we'll enter that into our consolidation worksheet. Back to the left, we got the information says P purchased a percentage of S voting common stock on December 31st, 2000 X0. The percent being 75%. The non-controlling or the cost is going to be the 2,220,000. P is going to be the parent, S is going to be the subsidiary. The consolidation or the purchase took place in 2000 X0, not the date of the consolidation. The non-controlling interest is going to be 740,000. That's as of the date that the purchase took place. In other words, the basically non-controlling interest portion of the net assets. The net assets at the purchase was 2,750,000, meaning assets minus the liabilities at the point in time that the purchase took place. And then we're going to be using the fully adjusted equity method. The consolidation is going to be as of 2000 X7. So at the end of 2000 X0, so now was when the purchase took place. This is 7 years later then. Then we have the book value and fair value of assets and liabilities are the same except for, so at the point in time that, this was back in 2000 X0 when the purchase took place, there was a difference between book and fair value related to inventory, land, and then there's going to be goodwill that we can calculate, and we'll come back to that calculation of goodwill over here. Then we have the 2000 X1 P sold land to S. So it went from P to S, parent to subsidiary, downward transaction, parent to subsidiary, had a gain on it. So it's just giving us the gain here of the 29,400. Obviously that happened way back in 2000 X1, which was after the point in time that we had the purchase. So, but not in the current year of consolidation, which is going to be 2000 X7. Then on January 1st, 2000 X7, S sold machinery to P. So now it's going from the subsidiary to the parent, upstream transaction. And we have a sale of machinery, a depreciable asset, and that happened in the current year that we are working on consolidating. And this is going to be the thing we will focus in on, will actually result in a loss here, which is a little bit different than what we have seen in the past. And so we'll deal with the loss rather than the gain. P purchased it years earlier for 450,000. I think it's supposed to be 5 years earlier for 450,000. The book value is 300,000. Useful life 15 years, and the sales price is going to be 260,000. We have the differential assigned to goodwill. Starting in 2000 X5, the intercompany services from P to S for a fee of 92,000. So we're going to say there's going to be services starting in 2000 X5, and this is going to be services, so we don't have any physical inventory going from one to the other or machinery or whatnot. This is just going to be services from one to the other. Starting in 2000 X5 from P to S, so parent to subsidiary, the fee then 92,000. And then as of December 2000 X7, S owed P 23,000. So there was still, in other words, an intercompany payable and receivable of the 23,000. Dividends declared but not yet paid, 5,000. Okay, so we're going to go back up top. I'm going to enter this into our little worksheet here. This is going to be our adjustment to the beginning entries. And what we want to think about here, some of those items that are going to be affecting, like that first journal entry, often the items that are going to be affecting the net income in the current year, things in our case like a loss and the depreciation. So I'm just going to set this up now, and then we'll analyze those transactions and then go back over here and populate it. So this first journal entry will typically start with a calculation of S's net income. So we're going to basically look at S here. We're looking at the bottom line. We're looking at the net income. So we want to start with that net income and then break it out, according to the percent, 75, 25, and then look at the adjustments from there. So I'm going to say negative of that net income is going to be here. Then we're going to break that out between this times 75%, and then the 25%. So that's going to be this times, I'm going to say 1 minus, let's say 1 minus the 75, or the, of course, 25. So that's going to be our starting point. Then we're going to deal with this loss and the depreciation and whatnot. Then let's go to the other side, the starting point. Let's just enter the starting point here. That's going to be the book value. That's going to be the assets minus the liabilities, or equal to the equity of S at the point in time consolidation taking place. Assets minus liabilities then equaling the $3,699,000, and then the equity also equaling the $3,699,000. So that's our starting point. So I'm going to go on back over here, and we're going to say, all right, so starting point there is going to be equal to the sum of, and we will pick up these numbers. So the assets and the liabilities. And so there is that. We're going to be breaking this out, controlling, non-controlling interest percentages. So that number times the controlling, which is the 75%. And then that number times the non-controlling, so times, or 1 minus to get to the non-controlling 75%, which would be the non-controlling, or the 924,000. So these two, of course, adding up to the 3699. Now let's go to our standard Goodwill type of calculation over here. So we're going to go over to our Goodwill type of calculation. So we're going to say that the net assets of S, this is as of the point in time that the purchase took place. So we're not going to be taking the information over here. That's 7 years later at the time of the consolidation. We're basically recalculating, and this would be in our working papers, of course, if we were doing these consolidations in practice, we would have this information. So we're going to say this is going to be the net assets at purchase. Then we're going to say there was a differential, and there was between, we got inventory, land, and then they gave us Goodwill. I'm going to pick up these two because we usually then calculate Goodwill at the end. So let's pick up these two. We're going to say, there's a differential in land and inventories. Let's pick those up. We're going to say the sum of these two. So we're going to have to account for those. All right. And then the fair value is going to be the sum of these two. And then the interest, the non-controlling interest is, you would think, 25%, or they give it to you. In this case, they gave us the 740. So then the controlling interest, you would think, would be the difference between the 2,876,000 minus 740, or the 2,136,000 if there was no Goodwill. But there is Goodwill, and the way we know that is because we actually paid the 2,220,000, and the difference between what we paid and what we would think we would have paid must be an intangible asset of the Goodwill, that 84,000, which they actually gave us over here too. So we can kind of double check that 84,000. Now let's go ahead and reconstruct the sales that happened over here. Now we have the sale of land, but it happened in a prior year, and all they gave us was the gain. So I'm just going to say, okay, let's keep that for what it is now. This sale down here, however, happened in the current year. So this is something we're probably going to use to pick up and fill in our beginning numbers here, and that's probably going to cause us some more problems because we'll have income statement accounts that are affected in the current year. So I'm going to right-click on this and make it green and say, all right, let's just check out, let's kind of analyze what would happen with this one, a sale that happened. So I'm going to put that over here, and let's just think about the sale that took place. Well, first, we're going to say the sales price was $260,000. And remember, when you're looking at these types of things in practice, there wouldn't be as many transactions as with inventory. Inventory, there could be a whole lot of transactions. We have to think about them like in aggregate oftentimes. Here we can actually oftentimes go look at the GL and see what the transaction is and pick out, the individual transaction and look at it. So the cost of goods sold, we're saying cost of goods sold, or just the cost, not the cost of goods sold, just the cost is that. And then the accumulated depreciation, which in practice we would have on the depreciation schedule. You would think we're going to do a little calculation for straight line to get it here, or they gave it to us a couple different ways. So notice they gave us book value here. So if they do that in a book problem, we could say, well, we know the book value is this then. So that means the accumulated depreciation must be this minus this. So that's one way we could do it, or a standard way they might give it in a book problem. In practice, again, we get it from the tape depreciation schedules, but they might say, well, here's this divided by 15, and then 5 years have passed times 5, and that would be the 150 up top too. So we could calculate it either way. you feel like doing so there. And you can double check it too, which is nice. So this sales price minus the book value, now we have a loss. So that's the thing that's kind of different here. Now let's think about, well, what would be recorded by the two people, the two individuals involved or companies involved. So let's think about the seller first. If S sells to P, we're going to say, all right, well, then the sales price for S would have been that they're going to get, the amount that they're going to get is this 260. The machinery is going to be going off the books for the cost of that 450. And then we have the accumulated depreciation, which is going to go off the books. So the difference between these two, that's the wrong number. It should be that number. So the difference between these two is going to be the 300,000, which is the book value up top. Then we're going to put the gain down below. So we'll put the gain down here. Negative sum, the plug there. Actually, it's a loss this time. That's the point. That's the point of the problem. It's a loss. It's going to be on this side for the 40,000. Then what's going to happen on P side? On P side, we're going to have, they paid 260. Cash went out for the 260. If we net this out and we say, okay, now they're one company, so these two things should be kind of like reversed entirely. But I don't have to reverse the cash because it kind of nets each other out. And then like the machinery would be like this happened. It went down by this, but then it went back up by that. So really we have to bring it back up by the 190. This isn't a journal entry. This is just to see the differences here. But we'll use it for to make our journal entry. And then the accumulated depreciation's got to go back on the books. And this gain, or in this case it's a loss. Let's put the right terminology here. It's a loss. 40,000, that needs to go away too. So that's got to go away. And then now it's on the books for 40,000 less than it should be. So because now it's on the books for P at 260, and it should be on the books for something greater, which is the 300,000. So that difference, the 40,000, isn't getting any depreciation recorded on it, and it should have. We should be recording depreciation on like another 40,000. That's not going to happen because it's on, it's on the books for 40,000 less than it should be. So what we're going to do is take that amount of the loss, which is now the amount of the machinery that's on the books less than what it should be. We'll take that divided by 10. That's because we had 15 years originally. 5 years had passed. Straight line depreciation, we're going to take 10 years. Or let's just do it this way. We're going to take this, and then we're going to take this as 10. And this will be the 40,000 divided by 10. That's the way it's set up to look. All right, so then that's going to be the added 4,000 of depreciation. We're going to have to add to the books this time, because if it was a gain, it would be over depreciated. We have to take it away. And now we've got to add it back to the books. Okay, so then if we go back up top then, so now we can kind of fill this component up. This will be our adjustments to like some of the income accounts related to the sales that happened. So we had a loss on the equipment. That loss, I'm going to say, all right, there was this loss now. That's going to affect the income statement. So I'm going to say that was for that 40,000. I'm going to break that out, controlling, non-controlling interest, because it's an up transaction. So it's an up transaction. So I'm going to do the breakout. And this shouldn't be a negative number. I'm going to say F2, get rid of the negative. This is positive. This is a happy positive thing. So we're going to take that 40,000 times the 75%. And then we're going to take the 40,000 times, I'm going to do it this way, 1 minus the 75%. And that'll give us the 10,000, 30,000 breakout, which of course adds up to the 100. Then I'm going to pick up the depreciation not recorded that we need to record. It's an up transaction as well. This one's going to be a negative or decreasing our balance here. So I'm going to pick up a negative of that 4,000. And once again, up transaction, so I'm going to break it out 75, 25, that times 75. And then let's pick up that number times, say, 1 minus 75, also known as 25. And there we have that. Now, the same thing's going to happen down below. So we have, this is our net assets. So this is our first journal entry that we're going to see is going to be adjusted. We're going to do the same thing down here. So we're going to fill it in with the same filling, even though the bun's different. It's a totally different bun, but the stuff between the bun is the same. So we're going to say there it is, and then we'll sum these up. So let's do the sums here. So I'm just going to add this up, the sum of these three, and then the sum of these three. We could copy and paste the formula, but I just want to emphasize what we're doing here. We're just adding up the column, adding up the column, adding up the column, and then adding up the column. And then right here, we're going to do something totally different. No, we're going to add up the column. Adding up the column. All right. Next, we want to take a look at the change in the differential here. So if I take a look, now I want to consider how these accounts, or how P is accounting for their investment in S, because this will help us to understand the reversing process, so, or the consolidation or elimination entries. So the two accounts involved are the investment account and the income from S. Now, oftentimes we look at the equity method and constructing the equity method because that's how we got to these two numbers. However, when we get a few years out, then it gets a little bit more difficult for us to do that for this number because, you know, it's been a few years of permanent account. It doesn't ever go to zero. So what we could do is try to back into that account, and that's useful to do from time to be able to help us out with the consolidation entry. So let's think about that. Let's try to back into this number. So I'm going to go back on over. I'm going to say, all right, let's take a look at the investment in S. Well, that's what we're going to calculate. Let's put a little colon by that. So I know that that's not where we start here. So then we're going to go to the net assets as of December 31st, 2000 x 0. So the net assets we can calculate as assets minus liabilities, or, you know, the equity section. So as of the current time period. So assets minus liabilities add up to that 3699. So let's put that up top. Let's put that up top here. So that's where it goes. We're going to put it where it goes, up top, equals the sum of the assets and liabilities. Assets and the liabilities. So we'll sum those up. Then I'm going to multiply that times the controlling interest, which is the 75%. And you would think then, if I multiply those out, that would be then, you know, what this number reflects. And if there was no adjustments that had to be taken into account that aren't on S's books that we're going to have to add during the consolidation, it would be if we had recorded the equity method correctly. But it's not, because we had some other stuff we got to do to it. So this account then we're going to call the book value of shares held by P, that we're going to have to adjust now. So then we have the remaining differential at January 1st. That's one thing, again, it's not on S's books, but we had this differential up top that was originally this plus this, but now like that inventory one went away, so now it's only down to this amount here. So we've got this differential that is going to be, that we're going to have to adjust it by, and it's actually our percentage of the differential, I should say. So it's going to be this equals this times our percentage of the differential, which is the 75% there. Then we have the gain on the land. So that was given to us right here. That was from P to S. So P to S, it's going to be a downstream transaction. So I'm going to pick up the entire amount because it went from P to S. So I'm going to say that's going to be negative of the 29.4. We're going to have to decrease that. Then we have the loss on the sale of the equipment, which we calculated over here. Loss on the sale of the equipment, which is this 40,000. We're going to take our portion of that, because so we're going to take 40,000 times the 75%. And note that this should be the S sold to P. So S sold to P, as it says over here, S sold machinery to P. So that's going to be the upstream transaction, and we're going to take a percentage of that. So we're going to say, all right, that's going to be the 40,000 times the 75%, let's pick that one up right there, and I need to make that a positive. So I'm going to just make one of these negative. So that's going to be the 30,000. Then we got to deal with this added depreciation thing down there, and that's going to be a negative or reduce, so reverse part of the loss, or basically a depreciation that we have to calculate on the added depreciation. So we'll see this in the consolidation entry. So we're going to get to that times, once again, the 75% transaction there. So that's going to be that. And then if we add this up then by summing equals the sum of those items, we get to the 2,889,975. So there we have it, and that then should tie out to our number here. So that's, we kind of backed into it, but that can help us then to reverse this out. That'll help us to get this account down to zero. So we're not going to do the equity method this time. We won't go through the equity calculations, which can kind of help us to get to here for the current year. We've seen that a lot, but so now we're kind of focusing in a few times on how we can kind of reconstruct in a calculation method this one, and that'll help us with our reversing entries, or our reversing entries. They should be consolidation or elimination entries. Okay, so now let's do those entries. So we're going to say, all right, let's do our worksheet here. We're going to be summing these up first, and then we'll enter our consolidation or elimination entries to the right. So I'm going to sum these up. So let's sum these up as we've done in prior problems. We're going to go ahead and copy that and paste it on down. Copy and paste it on down. So there we have that. We're still in balance down here. That looks good. We'll put our adjusting entries in here, or consolidation entries or elimination entries. We're going to start with the standard journal entry. I typically start with this one because it's the first one we need to adjust. We know that this needs to go to 0, this needs to go to 0, but I'm not going to put the number in there yet. We're going to then remove S's S's equity accounts. So we'll basically remove S's equity accounts, standard procedure. So I'm going to take the common stock and I'm going to copy that and paste it on down because we want down to dividends. That looks good. And then this is a credit here in the common stock, so we're going to debit it. So I'm going to debit it by that 930. This is a credit here, so we're going to debit it. So we will debit it by that 1,280,000. This is a credit here, so we're going to debit it in the retained earnings by that 1,330,000. And then this is a debit over here, so we're going to remove it with a credit. So we'll credit to that one. All right, standard procedure. And then we got the income from S. Income from S is going to be this one. Standard procedure would typically mandate that we take the S's net income down here, and we multiply that times the percent for it, controlling interest percent. So normally we would do this, which would be 75%, that times the 75%. That's the normal thing we do, normal thing. But we're going to adjust this one, and I'm going to make it colorful to indicate that with our table. So our table over here, we're going to say this is what we would have done, like that number matches, but no, we're going to do it this one according to the adjustment table we made. So I'm going to say, I would have done that, but no, we're going to do this because of the table. And then we're going to go to the non-controlling interest in NA. Non-controlling interest in NA. And this is what we would have done. Standard procedure would have been, okay, well now the other part of that net income needs to be allocated out by like 1 minus the 75 or the 25%. There. That's what that should have done. That's what we would have done. But once again, I'm going to make this a different color so it's more colorful. So we got that is what we would have done over here. But now, due to the table, we're not doing that. We're doing this. So we change that to this. And there we have that one. Then, normally, standard procedure, we go to the balance sheet side of things. And I'm going to say, now we need the non-controlling interest S, which usually is going to be the assets minus the liabilities, or the $3,699,000, or all of the equity. $3,699,000 times the non-controlling interest 25% would be a credit, and normally this amount would then be adding up to that same number. It doesn't here because we adjusted those two. It should add up to that, but we adjusted it here, so it's okay. So in any case, normally we would say this is the negative sum of this times 1 minus the 75, which is 25. That's what we normally would do. But we're changing it once again, which you probably predicted. We're going to change it. I'm going to make that blue. We're going to change it to that per the table. Per the table. Table's telling us what to do. We're not going to argue with it. Not arguing with the table. So then, normally, let's make that one blue. we would go up top and do the same thing up here, 75%. So negative sum of these times 75%. Normally, that's what we would do. But then, going to change that, making it yellow to indicate the fact that we're going to do that. Table, that's what we would have normally done, but we're changing it to that. That's what we're doing now, due to the table. So then I'm going to say, we're picking that one up. That's the one. That's the one. It's special. It's the one. Okay, so let's post it out. We're going to say, we're going to pick this up. Investment. The investment's going to go here. And then we'll pick up the comments. That doesn't go down to 0 yet, but that's okay. I'm not upset, not very upset yet, because I think we can still get there. And then we're going to go to the common stock. And that's going to be that. And then notice this was it before, plus S. Here's the total. Took away S in essence, back to basically P. Then we're going to go to the additional paid in capital. Additional paid in capital. It's going to be that 1,280,000. So here's what it originally was. Changed it to this. Then it goes back to what it basically originally was. Retained earnings. Then the retained earnings. Earnings that have been retained have not been given. We got that. Okay, same process. And we've got the dividend. So this all is doing what we would expect it to do. Here's the beginning numbers for P plus S's numbers gives us the total. Then we basically removed S's numbers to get us back to, in essence, the beginning numbers. Then we're going to go to the income from S. So that's going to be down here. Income from S. It's here. This one should go to 0 at the end of the day. And look at that. It does already. That's impressive. Okay, so then we've got the non-controlling. In the NA, that's going to be down here. Going to be picking that up. And then we've got the non-controlling interest up top. So there we have that. Okay, so that's, one of our core journal entries, of course. Then we have this difference. So we have this difference between the book and the fair value at the point in time the purchase took place, that differential. So we're going to be taking care of the differential now. Now, notice the differential originally included inventory as part of the differential when we calculated it over here, but the inventory is no longer there. So we don't have to deal with the inventory increasing the assets for that, but we do have to put on the land and the goodwill still. So we have to increase that because S didn't put that on the books, but we need to put that on the books to reflect it in the consolidation because at the point in time of purchase, these two things were higher fair value than the book value. So the land then is going to be going up by, we're saying, the 73.5 should be higher by the 73.5. And then we got to put the goodwill on the books because we calculated it to be the total of the 84,000. These are balance sheet side accounts, so we're going to be putting it to the balance sheet side breakout between the controlling and non-controlling interest accounts, the investment account, and the non-controlling interest on the balance sheet side instead of the income from S and the non-controlling interest on the income statement. So we'll pick those up. Investment account. Non-controlling interest, net assets, balance sheet. Going to add these up, which is going to come out to 157.5, multiplying it times 75%, the controlling interest. Let's do it with a formula because that's way cooler to do. So we're going to add those two up, close it up, times, and then we're going to be picking up these 75%. And then we'll take this one. I think it's best to see if you're going to work with this worksheet to pick these two up. And then multiply it times, and we'll say 1 minus the 75, which of course is 25. So that's going to give us the 25. And that should give us the debits equaling the credits, or this thing should add up to 0 at this point, which indeed it does. So that's impressive. So let's post it out now. We're going to say the land is up top. Land is up top. Let's post it out. Increasing the land based on the fact that it was higher at the fair value than the book value at the point in time of the purchase that took place like 7 years ago. And then we got the goodwill. Goodwill needs to be increased because we had some of that at the point of purchase. Other side being split out to the investment account. We need to put it here to help to decrease that investment account. So I'm going to say F2 plus F2. Picking up that 118, 125. It's still not to 0 yet, but that's okay. We're not done. Not panicked yet. Not yet. A little panic, but then we're going to go here we're going to say F2 plus F2, and we'll pick up that 39,375. So that puts us back in balance. Next, we had this intercompany transaction we want to take a look at, and that was this item down here, where in 2000 X5 they started having this intercompany relationship for services. Now, services are a little bit easier to deal with because they don't have the inventory or the equipment, but we still need to reverse the effects of the transaction. So if this happens every year and there's a transaction that happened in the current year, then the transaction on one side of the books would be just revenue and or cash and then revenue, let's say, and the other side of the books would be that they have an expense and cash. So we basically just need to reverse the expense and the income are going to be overstated now because we have an expense is too high and income is too high, but they should equal each other out because it's an equal and opposite. There was no thing involved. There was just a service. So we need to reverse the income effects, and then if there's anything still on the books with regards to the receivables and payables, we have to deal with that. Let's actually write this out because this is a little different. We haven't seen this too many times. Let's write this out. We're going to say that we had P services to S. So what would happen? We would have then for P's books, P would then say that they're going to get cash, and they're going to get cash in this case of this, and they haven't got cash of that yet. And so then they got AR, accounts receivable, which is that, and then sales, which is going to be the negative sum of these two. And then S books would say that they have an expense, which is basically the negative of that, and then they paid cash of that, and then they've got AP, accounts payable, of negative of that. So then we'd have a difference down here, the difference, and you're thinking, okay, I got to reverse these transactions. I could reverse the whole thing, but cash is going to net out. I'm going to say, well, cash nets out to like cash down here, and then we got the accounts receivable and the accounts payable that we're going to have to kind of net out, and then the sales are overstated as well. So the cash is okay, but now we've got accounts receivable is basically overstated, and now we've got sales is overstated. There's got to do something with that, and then the expense is overstated, so we got to reverse that. And then the accounts payable is overstated. Now, normally we'll think about this in two formats. We'll say, let's reverse these out and think about them separately, and let's look at the accounts payable and accounts receivable separately. Why? The accounts payable and receivable is something we should be able to find pretty easily when we do this consolidation, because we should be able to look at the subledgers for the receivables and payables and figure out that P owes S and S owes P and whatnot. And then the sales, we should be able to see the sales side as well fairly easily by generating reports to see the sales that went to each other. So we'll typically break those things out in two entries. So let's reverse basically the income expense side of things first. So I'm going to say, all right, let's say we're going to say the income is overstated. It went into, so we've got other income. Other income is overstated. It's a credit, so we're going to debit it to make it go down, and then the other expenses are going to be the other side that is overstated. So then we're going to pick up the number. The number is going to be the 92,000. So we'll say the 92,000 is going to be the debit and the credit. Okay, so then we have the other income. We're going to record this out. Other income is going to be here. This equals the 92,000. And then we have the other expenses down below. Other expenses is going to be equal to the credit of the 92,000. Then we're going to reverse the payable and the receivable related to this. So we'll say, all right, the payable is going to be overstated, so we're going to debit the payable. This is same thing as what we've seen in the past when there's an overstatement. We said there's an overstatement in the payable and the receivable. So we're going to say payable, receivable are overstated due to this because part of it had not yet been paid in the last year, and that's going to be for the 23,000. So the 23,000, and then we'll record this. We'll say, all right, then the payable is going to go down. So the payable is going to go down with a debit, of that 23,000, and then the receivable is going to go down with a credit, Doesn't sound as cool, down with a credit. It's down with a debit. So, but in any case, this one goes down with a credit of the 23,000. Okay. All right. So next, we're going to record a transaction related to the land intercompany land transfer that happened. But that happened in 2000X1. So there's going to be a gain that was related to it. And so that means that the land is on the books because it's overstated. So if there was a gain, that means that the purchaser would have overstated the land. Now, we don't have to worry about depreciation or anything because it's a land item that won't be depreciated. But that gain, then, we don't have to worry about the gain either so much because it's not on the current income statement. It rolled into equity, but the land is overstated. So we're going to be decreasing the overstatement of the land. So we're going to say, all right, the land needs to go down. So I'm going to credit the land. I'll put it on the bottom since there's only 2 accounts affected here typically. Not typically, but in this case, only 2 accounts affected. So I'll put it on the bottom. P sold it to S, so it's a downstream transaction. Therefore, going to put the entire amount then into the balance sheet side of things rather than I'm not breaking it out between the controlling and non-controlling interest, but rather putting it all into the investment in S. Then we're going to debit the investment in S. So we're going to go back up top, debiting the investment in S. That's what we need up there to bring it back down to 0. So that's good news. Looks like we're on the right track. I like being on the right track rather than the wrong track. So then we're going to put the land here. Land is going to be the credit. Now we'll do a similar thing for the machinery. That's going to be something that happened in the current year, depreciable assets that were recorded. So we're going to say that the machinery is going to be, let's actually consider this as our new thing here. So we had the sale that took place, went from S to P. So subsidiary to parent, upstream transaction, sales price 260, cost that was on the books for 450, then the accumulated depreciation 150 at the point of sale. That means the book value 300,000. That means a loss. So we have a loss here. So then if we think about what happened on S's books, they said that S was the seller. So cash went up, machinery went down, depreciation, accumulated depreciation went down. This is the book value, which is that 150. And then the cash they got was 260. So that's where the loss came from, which is this debit down here. And then we've got the P transaction. They put it on the books for 260 because that's what they paid, and cash went out. So these two will net out here. The machinery is going to net out to a difference of 190. So there's a difference of 190. We actually have to increase the machinery by that 190. Then the accumulated depreciation needs to go back on the books for the 140. And then this loss, which did happen in the current year because this sale took place in the current year, was on the income statement in the loss area here. So it's included in the loss in this number, I suppose, or loss on sale. So we have to take that off the book. And this isn't the only thing included in there, so I'm going to say it's a gain loss in here, but that's where it's going to go. Okay, so then we're going to say then that the machinery's got to go back up. So we got to bring this back up if this, like pretending that this didn't happen. This whole thing didn't happen. So we're going to say that this is going to go back up by the 190. And then the accumulated depreciation's got to go back on the books because that didn't happen. And so that's going to be going a credit back on the books to increase it by the 140. And then this is including a loss of 40,000 here. So there's other stuff in there apparently, but it includes the loss of the 40,000. So we're going to be picking up that account over here in like the name of the account. And that's going to be the difference, negative sum, or the 40,000. That needs to be reversed out. So let's post that out. We're going to go up to the machinery up top. We're going to say that that equals the 190. The 190 increasing it. Accumulated depreciation right under there. So we're going to say accumulated depreciation, the 150, and then the gain loss down here, gain loss is now, we're flipping it, it's got a gain now, so but we're removing that 40,000 which was included within it. All right, then we also have the depreciation that we have to deal with, because now we've got this on the books for the 260, and it should have been on the books for the 150 before the sale. So it's actually, let's see this one more time. It should have been on the books for the 300, and now it's on the books for 260, which means it's less by the amount of the gain, 40,000. And that means that they're not recording depreciation on the 40,000 that they should have been recording depreciation on, because it's on the books at a lower amount. So we actually have to then record the added depreciation that should be recorded on that 40,000 difference. We're going to take the 40,000 divided by 10 years useful life to get to the 4,000, then standard depreciation journal entry from here, which will simply be the debit to the depreciation expense and the credit to accumulated depreciation. So there we have that, debit and the credit. Go ahead and post that out. Let's post that out. So depreciation is going to go on over here. Picking up the depre, going to be adding to it. Need another 4,000 in there. Need another 4,000. Then the accumulated depreciation up top. Going to say F2 plus F2. Scroll on down to that credit for the accumulated depreciation. And there we have it. That should put us back in balance. So we note that these two are 0. We've got basically the equity section reflecting, in essence, the parent equity section. A couple things we can check at the end of the process.